a general analytical framework for the analysis of currencies and other commodities by Warren Mosler and Mathew Forstater. The vertical component. We begin with the vertical component of the model as presented in Figure 1. The tax liability lies at the bottom of the vertical, exogenous component of the currency. At the top is the state, here presented as a consolidated treasury and central bank, which is effectively the sole issuer of units of its currency, as it controls the issue of currency units by any of its designated agents. The middle is occupied by the private sector. It exchanges goods and services for the currency units of the state, pays taxes, and accumulates what is left over, state deficit spending, in the form of cash in circulation, reserves, clearing balances at the state central bank, or treasury securities, deposits offered by the central bank. For comparative purposes later in the paper, this accumulation will be considered warehoused. The currency units used for the payment of taxes or any other currency units transferred to the state, for this analysis is considered to be consumed, destroyed, in the process. As the state can issue paper currency units or accounting information at the central bank at will, tax payments need not be considered a reflux back to the state for the process to continue. In fact, the assumption of such reflux would imply a function of that process that this analysis emphasizes does not exist. This completes the basic vertical component. Agents are said to participate in vertical activity if they obtain the unit of account from the state, pay taxes to the state, or intermediate the process. Central bank policy determines the relative distribution of the accumulated currency units of the private sector between cash, reserves, clearing balances, and treasury securities. State deficit spending determines the magnitude of those accumulated financial assets.